Hi everyone, Jana Menina with Elite Mortgage. So today we're going to chat about forbearance. If you haven't heard about it yet, you will. And a lot of you are considering whether or not it's the right option for you. So what I wanted to make sure we covered is what are the short and long-term benefits, how does it work, and what is the overall impact on our economy if everyone were to use their forbearance option. So what forbearance is, in case you don't know, is it's an agreement that you make with your lender or servicer, and we'll get into that in a minute, to suspend your mortgage payments. Now, notice I said suspend. I didn't say to defer. I didn't say to forgive. I didn't say anything of the like. We're suspending the mortgage payments, and that is all. That means you still owe the money. So in spite of what you might see on CNBC, for example, the other day they got on and made it like it's some sort of amazing thing you get, like some perk, like, oh my gosh, this is so amazing. You could stop making your mortgage payments. Isn't that fantastic? And by doing so, all you have to do is tack it onto the back of your loan and you're good to go. That is not the way this works. And it's imperative that you understand what this really is so that in the event you are going to utilize this benefit or this tool, you know exactly what you're getting yourself into. So we talked about what forbearance is, which is just suspending the payments. What is it not? It is not a free ride. It is not debt forgiveness. It is not anything of the like. And unless you absolutely need it, and who needs forbearance? You've lost your job, you've lost your income, your business is closed, things of that nature, then you would be a perfect candidate for forbearance. You can utilize this tool to help you save your house. It's for people who cannot make their mortgage payment. It is not for you if you have tons of money in savings and you don't want to dip into it to make your mortgage payment. That's not who this was designed for. It's for the majority of Americans that live hand to mouth who without their income cannot make their mortgage payments. So they do not lose their homes. And think about why they would want you not to lose your home. You remember in 2008 when there's a flood of foreclosures on the market and there's a flood of people in distressed sales, what does that do to the housing market as a whole on a national level? It really impacts it in a negative way. And many people who use their homes as a savings account, if you will, they're building this equity for their future. It made it go away. They lost so much. And whether or not they've regained it and were able to hold on long enough to regain it over this period of time, you're talking about a number of years that is taken for the housing market to come back from the losses it experienced. So the government has made this tool available for people who are directly impacted. So what is the scoop with that? First and foremost, you can just know this, is that if you are in a position that you need to use it, it's a really simple process. If you do not need it, please, I am begging of you, and your country is begging of you, please do not use it. And we'll talk more about it in a minute. So you call your servicer and you just tell them, I'm directly impacted. I cannot make my mortgage payment, and they will set up an arrangement for you. I've heard two numbers as the initial forbearance period available. One has been 120 days and one has been 180 days. Yesterday, when everything was rolling out and the day before, it said 180 days. So 180 days that you do not have to make your mortgage payment. You're suspending the payment, but you are effectively doing this. Hello, Mr. Lender. I owe you $3,000 for April. I owe you $3,000 for May. And you are going to stack up these IOUs and you will then owe the money. It is not forgiven. So how is this money paid back? So we've seen a few different things. One is an agreement that you will pay it back in a lump sum after a certain specified period of time. So at the end of the forbearance period, you owe $20,000 in a balloon payment and it is due on such and such a date. That is probably your worst case situation. And you need to make sure that in the event you are asking for forbearance, that you ask them, how am I going to pay this back? And if a balloon payment is the answer, you want to ensure that that cannot result in a foreclosure. some of this paperwork is written that if you don't pay this back at the end of this term of this forbearance period, you can be foreclosed on. And albeit a super draconian approach, I mean, I get it, but you need to know that that is a reality and that is happening. So make sure you ask. The second way people are paying things back or are being offered to pay this money back is in monthly installments. So consider this idea. We'll just take an average payment in California. Now remember, and I should say this, in the San Francisco Bay Area of California, we're going to call this $5,000 a month. PITI. So when you're suspending your payment, you are suspending principal, interest, taxes, and insurance. That means that your servicer, whoever you're making your payments to, is making this payment on your behalf to the investor. So you can imagine the loss that they are experiencing when you're not paying, right? So they're making this payment, and we're just going to call it $5,000 a month for easy math. So as you stack up this number, and just say, for example, your forbearance period is 6 months or 180 days, that's $30,000. You heard that, right? $30,000 that you would owe. And so at the end of this, now we're going to stretch this out and we're going to make some payments. And we're not talking about you're going to get 3 years to pay this back or 4 years to pay this back. What we have seen so far is that this is like 6 to 12 months to pay this back. So you get through this coronavirus, you've experienced this huge financial hardship. No doubt you've had to dip into your credit cards and your savings and all this stuff to get through just getting by if you are impacted directly by this. And now you just get on your feet, you're back to work, and now your mortgage payment goes up $2,000 a month, $2,500 a month, so that you can pay back this money that you owe for during your forbearance period. That's something you need to understand before you agree to go into it. The third option we've been seeing, and this is the one that everyone seems to be talking about, like it's some sort of amazing, just awesome tool or trick. They found the holy grail. And that is, they'll just tack it on to the back of your loan. I know, I watched it on CNBC more than one time. I'm hearing the media spin on this, that you get to just tack it on to the back of the loan. And when you are, in the first 10 years, call it, of your loan, paying off your loan, it just doesn't even seem like it's in your realm of consciousness. It's like, whatever, like I can't even think about that. I still have 20 years or 25 years left. I can't even think about it. So the idea of adding 6 months on or 3 months on or 12 months on to the back of your loan, what's the difference between paying off in 2050 or paying off in 2051? It doesn't make a difference in your mind, right? Like that just, it feels, to me, that seems the way that it should be too. It just no, it doesn't matter. But it does matter. And it matters for a number of reasons. We cannot just add money due to the back of a loan. We cannot just change the term of one's loan. We don't just arbitrarily make these decisions. There has to be some sort of contractual modification. So remember, you signed a big stack of loan documents. And in that stack of loan documents, you signed a note and a deed of trust. And in the note, it said specifically, this is your interest rate for this period of time. This is your first payment date, and this is your last payment date, and this is your amortization schedule, and this is how this is going to work. And you have signed and agreed to that. And now you're going to go into this forbearance period, and now we need to change that potentially. So that means that your loan documents would need to be modified. They have yet to address what that modification is going to look like and if it will be quote unquote counted against you. So if you were around in the 2008 neck of the woods and you experienced a loan modification, then you know firsthand that that directly impacted your borrowing power moving forward. You know that guidelines for lenders were put in place so that you could not borrow as readily and as freely as you once could. So people in 2008 and those surrounding years were modifying their rate and modifying their term of their loan. So for example, some people got a principal reduction, so they were able to make their mortgage payment. Some people got an interest rate deduction, so they were able to make their mortgage payment. Whatever those were, they were very specific, and subsequently, all of these lending guidelines came out as a result because it is, in fact, exposing a weakness. If you need a forbearance period, you are are a riskier borrower because you needed that. You needed that time to suspend your payments. And therefore, this layer of risk, lenders get to decide if they are going to lend to you later. So you might not be thinking about that when you're thinking about right now, because right now you might really need that money. Right now, you might need this break. So I'm urging you to just consider this, is that when we make decisions in desperate times, when we make decisions when we are scared, those are not really the decisions we would typically make. Those are the decisions that we make when our brain is in this fight or flight mode. We are just trying to save our family. So you need to understand that these three ways of paying it back, which will have the least amount of impact to you. And you won't know that until you talk to your servicer. And we won't know that as a country until, we start getting more and more and more of these and they start rolling out. You'll start to see things come into play. So yesterday, one of the big servicers just said, and like one of the biggest in the country just said, you cannot borrow from us. We will not buy your loans if you're in forbearance. So you can't refinance yourself out of forbearance. And if you've been in forbearance, they're making that decision and they can. So you need to understand that that is a very real possibility. The next thing that you also need to understand is, although you just need an attestation to get yourself into this agreement with the lender to suspend your mortgage payments, that is the case for everyone else as well. So if everyone, or let's just say this number, I heard this number yesterday, 25% of homeowners, if they all apply for this forbearance period, that is going to cost, you ready for this? For 6 months, $70 billion to the servicing companies and banks, right? $70 billion. If they get to extend to the second forbearance period, depending on what they decide is going to happen next, then that's $140 billion to an industry that brings in $10 billion a year. So you're talking about this incredible loss. And those implications are even too hard to wrap our minds around right now, but it does impact somebody. And I think it's also really important to understand that when we talk about the Fed, or we talk about the Treasury, or we talk about the this or the that, although it doesn't feel like it's us and it feels more like an us against them, or like this is really far reaching, this is our government. This is our system. And there are things that are put into place like this CARES Act to help the people who need it. But if you're sitting on a bunch of money, or you just think that you don't feel like making your mortgage payment right now, the ramifications are significant to our economy and particularly our housing market. So I'm urging you, I'm really actually begging you to understand this fully before you just take advantage of the situation. There is no net benefit to you, because if you think about this, we'll go back to $5,000 a month. If you don't pay your mortgage, for 6 months, you're talking about you owe $30,000, and potentially you've been making your money the entire time. So who cares? You don't have any need to go into this forbearance period, but you decide you're going to. How much money are you really going to make on that $30,000 that you have? I mean, are you going to go invest this $30,000 and make a killing right now? Are you going to make interest on $30,000 that is consequential to your life? And if you are, okay. But there's way better ways that are less consequential to do this to the economy at large. But most people are not going to do that. Most people are going to keep it in their bank account, and then at the end, they're going to have to pay it. And they don't realize they're going to have to pay it because it's being sold as some sort of forgiveness, and they're waiting to see what comes next. But if you think about the implication to the housing market, and you think about what will happen, that all of these people will be in a position where there's going to be distressed sales, where there's going to be people getting foreclosed on, where there's going to be people that cannot afford to sell their house, so they just have to. We'll have a flood of inventory. What is that going to do to your property value? So if you think about that from a very personal perspective, if you are participating in this forbearance situation without needing to, what are you doing to yourself? And I say you are cutting your nose off to spite your face, right? You're going to make whatever you're going to make with the money that you're not currently paying into your you're obligated to pay, right, into your escrow account and to your servicer, but then you're going to lose such a significant amount of equity by taking advantage that there's no benefit at all to you. This is not some sort of savings plan. It's not meant for that. It is truly meant for people who cannot make their mortgage payments. So I think we've covered everything, how it gets paid back, how you use it. Oh, we didn't talk about the implications to your credit. How could I forget? So right now, part of the CARES Act is that the creditor will not report and cannot report negatively to the credit bureau. Okay, that's amazing. So what they've agreed on so far is that there will be no late reported. That's great. Typically during forbearance, and this is not a new concept, this has always been available to people, you're considered in default, but by making the arrangements with your lender, they won't foreclose on you. So it's a permissible default. So you default on your mortgage and then they report that to the credit bureaus that, you're 30 days, you're 60 days, you're 90 days late. And that in and of itself inhibits you from moving forward and getting a new mortgage for a period of time at a reasonable interest rate. You can get a mortgage, but it's not the same. So then the next thing is what will they report? And that's where they're trying to figure out. And like I said, things are rolling out. They're trying to figure out what they will report, because in good faith, the creditor can't report that it was paid on time because it wasn't paid on time. It wasn't paid at all. So what would they do? They think, the experts are saying, that there's going to be some blank spots there so that lenders will see that, like, just for example, April, May, June, July, that nothing is reported. It'll be an indicator that you were in forbearance. And again, they're aware. And so again, you're a riskier borrower, and from there, then they can make decisions as to whether or not they are going to in fact lend to you. And if they are, what will be the cost adjustment? How much higher of an interest rate will you have to pay with that added layer of risk? So again, I don't want to discourage anybody from doing this if it's needed. I want to discourage you from doing it if it's not needed. If you can still make your mortgage payment, make it. And if you cannot, then please, please, please rewatch this, reach out, ask us the questions, and we will direct you what to ask your servicer so that you're not blindsided at the end and that you are fully in awareness of what you are signing up for, and that you understand this is not free money of any kind. This is not some, oh my gosh, they're doing such a nice thing for me. This is an economic move to make sure that we preserve, or try to make sure we preserve, the equity in people's homes, and that we don't have another housing crisis. Okay, so I hope this is helpful. Thank you so much and have a great day. Take care. Bye-bye.